Okay. We're going to get started now. I think there's actually quite a nice sort of transition from the macro monetary policy outlook we had at the start, where Sir Dave Ramsden was also highlighting the real sort of the growth issue and productivity issue that the UK faces. We're also now even more clear on the challenge, not necessarily how to resolve it, but certainly on the challenge that truly sustainable growth would present. I don't think we're going to get the full answers from technology to both of those questions, but I think it would certainly give us a different way of thinking about it and an answer to the other question that's constantly asked, which is, is AI going to rescue us? Is it going to change the world? Is it going to rescue us but also put us all out of work? All of those things. Most of you in the audience, I think, will know of the work of the McKinsey Global Institute and some of the, over the years, dating a long way back, the analysis that they've done on productivity, which I think is sort of, at least in what they attempt to do, I don't think still there's very few people who attempt to do what Tara Ellis and her colleagues have tried to do over the years there. She's going to speak first, I'm told, very much sticking to the 15 minutes. We then have Joseph Briggs, who's the Senior Global Economist at Goldman Sachs, who has also done a lot of work on generative AI and how that could affect productivity and growth. He's warned me that that he agrees with quite a lot of what Tara says, but I think we should also be somewhat reassured by that, because it means we might reach some conclusions. And I know they also, in their talk, but also I hope in the discussion, will be able to end up taking it back to the macro consequences of some of what they've talked about. But Tara, let's start with you.
Thank you very much, Stephanie, for the introduction. Thank you for the opportunity to be here today. I very much look forward to sharing with you some of our thinking on the impact of the latest wave of technology on productivity and growth. But also look forward to the conversation, because there are a lot of different things to consider and it is not clear-cut by any means. I think of artificial intelligence as a bit of like an unreliable sports car. When it works really, really, really well, it's absolutely amazing what it can do. And then when it works badly, it's deeply disappointing. And that's also why it's incredibly hard to predict the impact it might have on the economy. I should also say, by the way, that I'm not just going to talk about AI. I'm going to talk about the broader advent of digital automation and other technologies that put together do have the promise to actually boost productivity very significantly. But we have been set an exam question: is technology the answer to flagging global productivity? And my short answer to that is no. Now we could all go home, or I can maybe give you a little bit more nuance and a little bit more detail. So what I wanted to share with you was some thoughts, first of all, on the potential of these technologies to drive productivity growth, but explain why it's not necessarily very evenly distributed. Talk a bit about adoption, which I suspect will be fast, but not necessarily as fast as we all think. Impact on jobs, which all of our analysis suggests is actually going to be positive in terms of net number of jobs. But that doesn't mean that we won't need to go through a massive transformation in our labor markets or inside our own jobs. Productivity, where, yes, the potential is huge and probably the impact will be positive, but it will not necessarily show up in the numbers very soon. And finally, on growth, where productivity is, of course, only part of the story. So starting with the potential, I say that it's huge. How huge? Well, my colleagues at the McKinsey Global Institute have estimated, based on all the tasks of all the occupations in the global economy, how much of those tasks could be automated using today's technology. So not tomorrow's technology, today's technology. And the answer is between 60 and 70%. So if we turn that into a productivity number, output stays the same, input goes down by 70%, we get more than 200% boost in productivity. So that's pretty nice. Now, obviously, we're not going to get it overnight. And what's quite interesting about this analysis is when you look at the lighter blue bar there, that's the impact of generative AI, which is the bit that we hear the most about and which is currently most hyped. So this is ChatGPT, this is Midjourney, this is all the kinds of AI that is allowing us to produce images and language that are close to the kind of images and language that humans would produce. It's only a very small part of the story, so let's keep that in mind. Having said that, zooming in on that generative AI piece, it really illustrates nicely also the way in which these impacts are very uneven. My colleagues have done analysis suggesting that a couple of trillion of dollars could be added to the global economy on an annual basis through generative AI. But they also think that 75% of all of that impact is in the top right-hand corner of this chart, which is essentially only about 6 functions in businesses or so. A lot to do with customer service and sales and channel management, and a lot to do with R&D, software development, and innovation. The rest of it, it'll have an impact, but it's going to be relatively small in terms of the actual numbers that we're talking about. What's quite interesting about that, I think, is that generative AI has one reason why we might be underestimating its potential, which is that if it innovates the way we innovate, then it will have a massive kind of potential second-order consequence on the rate of progress in technological development. But I'll come on to say many other reasons why the numbers might be exaggerated, or at least misleading. So what about adoption? All this potential is fantastic, but when is it actually going to arrive? When are people actually going to see it in the productivity numbers? This chart shows you what we thought 5 years ago in 2017 with the dotted lines. That was the kind of adoption scenarios we had back then. And then the solid lines are the adoption scenarios we have today: early adoption, late adoption. And there are kind of 3 things I want to pull out of this chart. First of all, yes, adoption scenarios have shifted forward. We think adoption is now going to be faster. Why? Well, the user interface for these new technologies is a complete game changer. All you need is a web connection and to be able to read and write. Most people on this planet have that. In the olden days, you needed a CTO, a technology team, a massive set of consultants coming in and reframing and redesigning all your IT systems, lots of training, lots of coercion to get people to use the new systems, et cetera, et cetera. With generative AI, the adoption is going to be a lot faster. The other thing you see on this chart, which is, I don't know if any of you heard Elon Musk at that AI conference the other day say, there will be a day when we don't need any people to do any jobs. All of it can be done by AI. Well, looks like quite a lot of people agree, because this is based on some kind of deep expert assessment. So by 2060, in the early adoption scenario, 100% of the work we do today could be automated. Will it happen? Well, I don't think so, but it's useful to be aware that it's not a technical impossibility whatsoever. The barriers are different to technological barriers. The final thing that you see on this chart, though, is this massive distance between these 2 scenarios. So we just don't know how fast this technology will diffuse. We just don't really even know how much it will boost productivity when it finally arrives. And ChatGPT, which is probably the most talked about generative AI technology, I think is a really nice example of why it's so hard to pin any numbers on this thing. On one hand, incredibly impressive, 180 million users so far. That's the fastest adoption rate of any app, any technology, any software, any kind of service or product we've ever seen. And 1.5 billion users per month. That's a big number. But when we put it into a broader context, well, it is only 3% of the world's population, apparently, that has signed up. And more importantly, the average person spends 7 minutes when they visit ChatGPT. Now, even if they did it every single day, that's hardly a transformational impact on their productivity. So some of these adoption things can be really exaggerated. And one of the reasons is that when we think about the use cases, we tend to think of tasks, not jobs and not societies. So there's good RCT evidence that for coding, if you use a co-pilot, your productivity can easily go up by 70%. My son is a computer scientist. He spends a lot of time coding. Does he spend his whole time coding in a job? Absolutely not. He spends a lot of time talking to his boss, his peers, his users, people who can advise him on the system, problem solving, the kind of bigger picture. And so when you add it up at the level of the actual occupation, this is another RCT result, this time from call centers, you get to an improvement in productivity of maybe 14%. That's still very substantive, but not everybody works in a call center or as a coder or in some of those kind of more exposed occupations. And fewer than 30% of the global work today is actually done in jobs which could be more than 15%, see a more than 15% productivity boost. So it's very uneven, and the actual adoption rates, I've mentioned this a few times already, they're not that impressive. We don't actually have really good data on this, but there are a couple of surveys by the European Investment Bank and then by the ONS. In Europe and in the US, maybe 30% of businesses say that they are using either big data or AI. That means 70% of businesses are not. And the average person, by the way, works for that 70% and not the 30% who already adopted. In the UK, interestingly, from the ONS survey, 9% say that they do use it, 7% don't know, and the rest say they're not using AI. I think they're wrong, by the way. This is a really important feature of AI. It's embedded. We're all using AI because we use Google Maps, we use image recognition for our iPhone to open up. We use various search engines which are powered by AI in the back end. And very soon we'll all be using Microsoft Office products which all have AI in them. So probably 100% of businesses are using it, but are they using it purposefully to drive productivity growth and redesigning all the processes around it? Answer is no. And that means we're probably going to have to be quite careful about the sort of estimates we make about the macro impacts in the short term. The jobs impacts are something I don't have time to go into in huge detail, but I did want to point out this really interesting finding that generative AI is likely to be a bit more of a leveling force than continuing the vastly skills-biased path that we've been on in terms of technology. This just shows pre- and post-generative AI, the automation projection in 2030 in a mid-case scenario of work by wage quintile. And so we can see that actually the lowest wage quintile is the least likely to be automated. Why? Well, because we pay so little for those jobs that it's not worth automating them. And a lot of them also have a lot of unpredictable physical components, which are really hard to automate. So this would be people like cleaners or gardeners. The second wage quintile, it starts to pay off for firms and organizations to automate this work. And a lot of it is quite routine and quite easily automatable. So it could be data entry in terms of kind of gray or white collar jobs, or it could be process jobs in a manufacturing setting. And so those probably are still the most vulnerable jobs in terms of automation. And what's really interesting is with generative AI, we're suddenly seeing massive automation potential in the highest paying jobs. This is lawyers, this is R&D professionals, this is the software producers I just mentioned, this is indeed management consultants, maybe even bankers, anybody who's doing any writing. Will it take all of our jobs or will it augment them? The analysis so far suggests that it's very likely to be augmenting rather than reducing the number of jobs, net. But of course, there'll be huge distributional effects. So when we put that all together, what does it mean for productivity growth per annum? Well, I've intentionally been very annoying and giving you a massive range because I don't know. It depends on all of those adoption curves and it is very uncertain. But at the top end, if we're on a fast adoption path to 2040, we could see 3.3 percentage point increase in productivity growth every year. That's a pretty enormous number considering historical productivity growth, especially in developed economies. Or we might see just the tiniest little bit of extra productivity growth, 0.2. And so it's going to be somewhere in between. Now, from the point of view of the economy, of course, we wish we were on that kind of higher adoption path because we desperately need this productivity growth. I'm sure you've all seen this chart or similar charts before showing the composition of growth for the last 5 decades and the degree to which the demographic dividend and participation gains are kind of less and less and less and less each year. And we cannot rely on that sort of source of growth anymore. So productivity is going to have to do the lion's share and all the heavy lifting. And of course, we know that productivity growth has weakened recently. And so we do hope that this technology can help us boost this back up. Final point that I want to make, though, is that technology alone will do none of it. In order to drive growth, we not only need technology, but we need the skills. We need lots of other intangible capital, like organizational capital, IP, the data needs to be in good shape, et cetera, et cetera. And we need physical investment to really boost that productivity number on the previous page. And of course, even if we get productivity growing, if we don't have high participation or we have headwinds from demand, then the growth is not going to be there. And final point is that growth is not the ultimate objective here. Of course, as Dieter was saying in the previous session, we want a sustainable, inclusive society, which could be measured in lots of other ways, but GDP is probably not it. And so we need to steer this growth in a way that also delivers those other goals. But hopefully that's given you a bit of an overview of what we can and cannot say about the impacts of technology on growth in the future. Thanks.
Thank you. Over to you.
Thank you, Stephanie, and thank you, Tara, for kicking us off. My part can be very short because Tara said everything that I was going to. You know, it's kind of remarkable about how much agreement there is that generative AI could have a significant impact on the economy. In my job, I talk to a lot of investors, and you know, over the last year, there's been very few people that have come to me and said, I don't think that AI is going to have any impact. I think that AI is a complete bubble. There's a lot of skepticism around the timing, which I think is very warranted. But you know, there's broad buy-in that generative AI is going to have a massive impact, and you know, our views are very similar to Tara's in that regard. So what I'm going to do for my time is I'm going to spend the first 5 minutes or so just running through some of our key results, which are going to be very similar, point out some of the nuances that I think are important to think about when looking at the productivity effects of generative AI, but then spend the last 5 or 10 minutes talking about how we've tried to translate generative AI to a GDP impact. We recently, just a couple weeks ago, upgraded our long-run growth forecast to incorporate a boost from generative AI. What we ultimately penciled in is going to be a little bit smaller than some of the eye-popping numbers that I'm going to present in the first part of the talk, and that are very similar to what Tara presented earlier. But I'll explain why we think that the net impact on GDP might be a little bit smaller, if not significantly smaller, than the productivity gains that seem possible would otherwise imply. I was very glad that Tara made the point that the interface is the key innovation over the last year that's making a lot of these productivity gains possible. The reason that generative AI has leapt to the forefront of the public and markets is because anyone can use it today. This is a point that I personally have an attachment to making because my sister's a software engineer. And so we argue all the time about whether or not it was the increased capability of models that have made generative AI so powerful, or whether it was the interface. I'm firmly in the interface camp. What I can say is if we hadn't seen the advancement in the interface, I don't think that we'd be nearly as bullish on the economic impacts of generative AI as we are. Our baseline estimate in terms of the tasks that can be automated from generative AI, we use a similar approach to Tara and her team. We came up with an estimate of 25% of all work tasks in the US economy being potentially automatable. There's a lot of spread across different industries. I think the pattern's pretty intuitive. Anything that has a lot of repetitive, routine tasks is more subject to automation by generative AI, particularly those occupations that produce a lot of content. One of the assumptions that we've made in our analysis is we've assumed that any task or any job that has a significant physical component is probably not going to be automated by generative AI in the near term. That's not to say that broader automation can't occur. We've seen advances in robotics for the last 20, 30 years. But I think it's worth stripping out what is a generative AI impact from these broader automation trends. And the reason that I bring that up is that if you look at what you would estimate if you did assume that generative AI were to speed up the adoption of robotics as well. It's easier to come up with much bigger numbers than what we've come up with in our baseline. And so the punchline from all this is that the effects are big. There's a lot of tasks that are potentially automatable. And the reason for that is that there's just a lot of workers that spend a lot of time doing things that generative AI models are already very good at. We have taken a view that we're probably not going to see as much worker displacement, at least in the long run, as many people fear. The reason for that is if you look at within occupation or within industry distribution of the share of exposure, we don't see a lot of jobs that are 50, 60, 70, 80% exposed to automation. We see a lot of jobs that are 0, 10, 20, 30, 40% exposed to AI-driven automation. And the reason that this is important is that I think that if the majority of your job is not potentially automatable by generative AI, similar to Tara's point about coders spending a lot of time actually interacting with their bosses and talking with their team and designing the workflow that they're engaged in. That because these tasks aren't automatable, it's probably going to limit the amount of worker displacement that we've seen. One chart that I think makes this very clear that we shouldn't be so concerned that technology is going to lead to widespread worker displacement. This actually comes from a recent paper by David Otter. I thought it was fantastic. But basically, only 40% of workers today are employed in occupations, not jobs, occupations, that existed in 1940. And so another way to think about this is over the last 80 years, about 85% of all employment growth has been driven by the technological creation of new positions. And so I think that the historical record is very clear in the long run. Technology will drive employment growth. This can happen either because of the increase in aggregate demand that raises labor demand in areas where labor does have a comparative advantage. It could also occur because of the emergence of AI-adjacent occupations. I think 30 years ago, nobody knew anyone that was employed as a web developer, but today we all have friends that are employed in these type of fields. And so there will be new jobs that are created. I think that some of the concerns around widespread displacement are a little bit overblown, although it could be a little bit of a choppy transition in the near term. I had to laugh when I looked at your slides, Tara, because the range that you had of 0.2 to 0.3 is actually almost exactly the same as what we came up with. That wasn't by design. The point being that depending on what assumptions you make on how much displacement you see, the adoption timeline, how powerful generative AI ultimately is, you can get a wide range of outcomes. The one thing that I would emphasize, however, is that whether or not the effect is 0.2 or 2.9 or 1.5%, in terms of the boost to overall annual productivity growth, these are all economically meaningful numbers. And so, in a room full of economists, I probably don't have to emphasize this as much, but if you're talking to companies, sometimes they think like, 1% boost to productivity, that's not that much. In most of the scenarios that we've considered, we do think it will have a meaningful impact on the economy. The big question is how much and over what time horizon. As I noted, we recently updated our global GDP forecast to incorporate a generative AI effect. What I'm showing on this chart is the same estimates that I had on the last chart, but rescaled to different countries. The effects are pretty intuitive for DM economies. The exposure in terms of how much of a boost to annual productivity growth you could get following full adoption over a 10-year period are pretty similar to the US. Definitely smaller in EMs. The reason for that is that there's more of a physical component of work and less of a service-based content creation economy that generative AI is likely to automate in the near term. On average, though, we come up with about a 1.2 percentage point boost to overall global productivity growth. Again, this would be a meaningful boost and fairly sizable relative to the recent productivity growth trend. If we were to take this estimate and just translate to GDP blindly, we would probably want to map it 1 for 1, which would mean that global GDP growth would be 1.2 percentage points higher, if generative AI was adopted over a 10-year period. The reason for this is that, as capital accumulates to match the increase in labor productivity, the long-run impact relationship between labor productivity and GDP should be 1 for 1. We didn't upgrade our growth estimates by nearly this much, and there were several reasons why we thought that there should be more caution and that the net effect on GDP growth is likely to be much smaller than this 1 for 1 translation would imply. The first is that absent technology change and absent the type of breakthrough technology change that really establishes a new level of potential productivity growth does tend to slow over time. The right-hand chart of this screen is showing productivity growth, 50-year annualized, going back to 1500. And what you'll notice is that we do see a pretty clear cyclical or long-run cycle pattern emerge, where there's an initial technological breakthrough. The easy innovations and easy efficiency gains are harvested. This leads to a rapid acceleration in productivity. And then over time, as the incremental efficiency gains become harder to achieve, the effect on productivity growth tends to slow down. You can see that we have been in a long-run period of decelerating productivity growth in the U.S. and other major economies. I'm sure this isn't a surprise to anyone in this room. But the point that I'd like to make is that if we didn't have the type of technological advancements from generative AI, this trend would probably continue. And so we would be, what we are doing is we're adding on an AI automation productivity boost on top of what's an otherwise slowing trend. By our estimates in the US, for example, productivity growth would have probably slowed 0.2 percentage points over the next decade, absent the AI effect. And so you probably want to lower the trend to which you're adding on any sort of AI boost to when trying to estimate the impact on GDP. The second reason that we don't think that the full AI productivity boosts that we think are possible are going to translate one-for-one to GDP is that over the last 20 years, a disproportionate share of productivity growth has been driven by information and communication technology advancement or technology investment already. In the U.S., about 40% of productivity growth, annual productivity growth over the last 20 years has been driven by ICT investment and the total factor productivity gains that were enabled by information and communication technology. The UK, it's pretty similar. Other economies, the effect is even higher. And so the point that I'm making is that if we think about generative AI as really the next wave of information and communication technology, then it might not necessarily be purely additive to the boost that's already built into underlying productivity growth trends. And so this is another reason why you don't want to treat it as purely additive. You probably would at least be double counting part of the productivity growth boost. The last reason why we were somewhat cautious, is something that Tara summarized quite nicely, and that's that despite all the optimism about adoption, despite a common narrative that everyone's going to be using generative AI in the near term, we're kind of skeptical that you're going to see large productivity growth effects in the next few years. If you look at prior technological advances, the two that we focused on were the emergence of the electric motor and the emergence of the personal computer and the information technology revolution. Generally, what happens is you see productivity growth accelerate about 20 years after the initial technology breakthrough, at a point when about half of companies have adopted the technology. We're a long way away from 50% adoption. It's hard to know exactly when the key technological breakthrough that enabled generative AI occurred. It's often easier to tell in hindsight. We're with the benefit of hindsight. But the point being is that historical evidence tells us that it can take a long time before you see the macro productivity growth effects show up, even if the technology advancement is occurring. This view actually aligns quite well with some of the survey evidence that we've heard from corporates. Here I'm showing survey responses from a couple of different places. But the punchline is that very few companies expect to start using generative AI in the next 1 to 3 years. That said, most companies expect that generative AI probably will have a significant impact on their labor force over the next 3 to 10 years. And so, based on this, based on the historical patterns, we are thinking about any sort of effect showing up more over the 3 to 10 year horizon, so the second half of the decade into the 2030s. So what does this all mean? We tried to take into account the slowdown in underlying productivity growth, our baseline AI effect estimates, as well as a reasonable adoption timeline, and also subtract off the offset from the contribution that information and communication technology is already contributing to overall the underlying growth trend. After doing this, we came up with an estimate that over the next decade, we are going to see a significant boost to GDP. By 2034, we've raised our US growth forecast by 0.4 percentage points. And so this, there's two ways to look at this. If you would have asked me 5 years ago, is a 0.4 percentage point boost to potential GDP growth very significant? I would have said absolutely. It's a significant percent increase from what we've been growing recently. That said, you can tell that the numbers are much smaller than the 1.5 percentage point boost to productivity growth that we started out with. And so, the punchline is that there does need to be some caution in thinking about, how big of an impact on growth we're going to see from widespread adoption of generative AI. I'll close out with 2 points that are kind of separate from the productivity growth effects, but I think are fairly interesting, particularly in a room full of economists. The first is that we've done some work trying to estimate how big of an investment cycle you could see to facilitate an AI transition. This is, it's very hard to put exact numbers on this, like everything associated with generative AI. The reason being is that you're looking at models that are growing exponentially quickly. At the same time, computing power is growing, it's falling, or the cost of computing power is falling at an exponential pace. And so I think that the ultimate size of the investment that's going to be necessary to facilitate the AI transition is going to depend critically on timing. It's also going to depend critically on at what point do generative AI models getting larger no longer lead to significant productivity gains. Our guess in a stylized scenario was that you could see an investment wave or an investment cycle to the tune of about 2 percentage points of GDP. So pretty significant, but I would highlight that there is significant uncertainty around these numbers, and if you were to delay the adoption timeline by, say, 2 years, the effects would probably be much smaller given the rapid decline in computing power. The last point that I would make, and I don't know if it's easy to read the text on the screen, but in addition to being a macro story, there are a lot of nuances around how generative AI is likely to impact financial markets. The equities, this is based on some of the work that my colleagues on our markets team have done, but the equities impact is fairly straightforward. Equities reprice an expectation, and so when you expect future growth and expect future margin or earnings gains, then you should see an increase in equity prices, which is largely what we've seen, at least for some companies associated with generative AI so far. From our perspective, generative AI is probably going to look more like a DM growth shock and a US growth shock in particular. The reason being is we think that DMs in the United States have the most gain from adopting generative AI. They're also probably going to be the first to start using generative AI. And so this could lead to a dynamic where growth accelerates in DMs. You also get this investment cycle, which should be dollar positive for some period of time. Interestingly enough, the commodities impact could also be positive. The reason being is that you're increasing aggregate demand without generating any efficiency gains in production. That could put some upward pressure on commodity prices. And finally, the big question: what does it mean for interest rates? We don't know. On one hand, higher potential growth is probably good for interest rates. On the other hand, you are going to get the deflationary impact, and so the net effect on nominal interest rates is very unclear. It will depend on whether it's anticipated or unanticipated. But unfortunately, we can't answer the multi-trillion-dollar question in the room. Thank you.
I guess I'm going to quickly just check with Tara, because obviously you didn't mention interest rates and you're less in the business of thinking about interest rates, but what would be your answer on the net impact on interest rates? We're obviously talking about the long-term natural rate.
It's incredibly hard to answer. I think in general it'll be disinflationary, and so maybe that means they'll be a little bit low, but investment opportunities will be greater, because this is very much a complementary technology to other investments. It's not a substitute, and therefore you might see better returns. So who knows?
Okay, another version of who knows. And I also wanted to ask you, Joseph brought in the global picture. I mean, specifically in terms of the differential productivity impact in the developing world relative to developed, and obviously made the point that the sort of immediate growth impact would be positive more positive for DM. I just wondered, I mean, how you think about the international variation, whether it would be a similar analysis, because there was less of it or less specifically in your presentation. But also, we've tended to think in the past particularly in some of the more recent waves of technological change, that there was potential for accelerating catch-up in countries, for example, with telecoms and everything. It feels like that isn't the right model for thinking about this because of the pre-existing conditions for generative AI. So I just wondered how you should think about it if you're India.
So I think it is going to be both. It's going to both benefit more the developed countries in the short term, because there's more automatable work there, and labor is more expensive, so it makes a lot more sense to automate now rather than later. But actually, we see the investment potential for this in the emerging economies being enormous over time, and of course that labor arbitrage potential they have is closing all the time. So it's just, I think it's more of a timing question of adoption will probably happen faster, and the complementary human capital is probably more present currently in the developed economies, but emerging economies will catch up quite quickly. Partly because of the sort of thing that Joseph mentioned around the user interface, and it ultimately, most businesses, if you think about it, aren't going to have their own software engineers writing their own AI programs. You know, you think about the average business in the UK has probably like 100 people, and almost certainly not a chief technology officer, and almost even more certainly not a machine learning expert on their books. And so they're going to adopt it by just buying technology that already has it inside. And that's going to be the kind of second wave of adoption, which I suspect will happen in any country, regardless of whether they are producing this stuff.
And it would make them easier. It'd make it easier for them to compete directly with developed country workers. So there'd be that. Okay, questions? Mark, and then we've got a question at the back.
Mark Cliffe from Exeter University. I wonder if you could just explore a little bit the effects on public goods, as in health and education, because it strikes me that AI is going to have a transformative effect on healthcare, personalised medicine. This potentially will have effects on labour supply, longevity, also in terms of the impact on education and the quality of human capital in general. To see it purely from, as it were, a corporate perspective, I think would be a bit of a mistake. So I'd be interested for you to talk a little bit more about the broader systemic effects of this.
Yeah, sure. I can start, and then I'm sure Joseph will have complementary comments to make. In our analysis, we do look at the entire workforce, so that includes a really large chunk of public sector, because it's a large chunk in most developed economies. And you actually see the biggest impact on teachers and healthcare workers in general, in terms of the ability of generative AI to augment what they do. So this means we will hopefully have slightly fewer staff shortages, because the real problem in those areas at the moment is we don't have enough people. But of course, in terms of the productivity, so quality adjusted output of those sectors, we're also looking at potentially massively enhancing it, because you can get much more personalized, you can get much more streamlined, you can use data to optimize your processes better, so that people don't end up wasting time. So at the moment, a huge problem in healthcare is that people show up for an operation, but then one person out of the 11-person team that needs to be in place is sick, and the whole operation gets cancelled, and all the other 10 people who showed up to do their work can't actually get a single unit of output out of that hour that they were there for. So all of those sorts of processes have enormous potential to be improved with all this technology. Having said that, you know, it's not necessarily a really rosy path historically of adopting technology in these particular sectors, because it's just really, really hard to embed new systems into an incredibly complex set of organizations. So I think the adoption challenges, both in terms of providing the software and the systems, and then the training and the change management that needs to go alongside all of the tech, I think that will be very significant. And there will be lots of regulatory barriers as well before people feel comfortable, even if it's only augmenting rather than making decisions.
Cheers.
Yeah, I'll just add on that our estimates would also tell you that these are two of the sectors that are going to potentially benefit the most in terms of efficiency gains from generative AI. That should mean that costs fall, but to Tara's point, I think the regulatory backdrop makes it more challenging to realize some of the gains, in these sectors relative to others. I think that this probably will slow down the adoption timeline meaningfully. It will take some, more time for doctors to start using generative AI, I think, than maybe some other industries that are less regulated. And as a result, I would look for a more delayed adoption timeline, but otherwise generally agree.
Sorry, just have a quick sort of follow-up on this. So I think you're missing the point that I'm trying to make, which is I think you're missing the point that I'm trying to make here, which is if you have a radical levelling up in the quality of health and education, that is going to have much broader consequences than just the effect on employment in education and health. There could be a huge levelling up, for example, in the emerging markets in terms of educational standards, which will have pervasive effects on the economy. Likewise, if people's health is radically improved, it's not just a cost saving for the health service, it means that you have better workers in general who are going to live longer, which has all sorts of implications for insurance and pensions and so on. So there's if you like, more of a sort of systemic effect than perhaps some of the estimates that you've presented suggest.
For sure. And one of the things I would emphasize is that in our work, and I think Tara, your approach is kind of similar, we are really focusing on the task automation and the time savings that are possible. You hinted at this in your comments, but there's potentially other ways that generative AI could impact the economy, particularly if it accelerates the idea creation and the innovation. That would certainly be an upside to our estimates that is in line with what you're suggesting. Healthcare and education, we've already seen some early discussion around the possibility of this dynamic occurring. The drug discovery is something, or the potential for an enhancement of drug discovery is something that our equity analysts have written on. There have been companies that are working on developing your personal tutor that will, adapt to your learning style to improve education outcomes. If these things do prove fruitful in the long run, then I think that there's probably more upside to growth in the manner that you suggest.
I'll just grab that question. Maybe take, because we've got a few now and we've run out of time. So there was a question at the back before. Yeah.
Hi, Alex Mash. I work at the Competition and Markets Authority, though very much speaking in a personal capacity. I have two questions, if I may, which may be greedy. Feel free to ignore one. The first one is about statistics. What statistics do we actually need to collect over the next 10, 20 years to actually have a good answer to this question, so we're not still scratching our heads like famous economists were in the early 90s about ICT? And the second question, which is maybe too micro, is about the role that competition plays in the adoption of these technologies. Tara, you mentioned that we all use Microsoft Office, which already uses AI, which screams market power to my mind, and the potential for AI to reinforce market power. How does different competitive landscapes affect your different uptake scenarios, noting the fact that AI itself may distort them?
Because we're going to be squeezed, so very quickly, there's one here and one there, and then we'll see if we can mop them up.
Tomasz Lelek from T. Rowe Price. Have you at all thought about the political backlash to AI, both in terms of people complaining AI is taking my job, but also this kind of Terminator fear that AI will substitute us as a race at some point? Have you thought about the effect of this political backlash on the adoption of AI, and whether that might slow it down much more than you expect?
So I thought there was one in the middle here, but no. Yeah, here, unless it's been answered.
Hi, Sharmila Whelan. I've got two questions for Joseph, and it's to do with your chart, graph number 8, which showed the percentage point additions to GDP growth from generative AI by country. Two questions on that chart. One is, why is India at the bottom of the pile, behind Ecuador and Kenya? What's the implicit thinking behind that? That's number one. Number two is, you've got the percentage contribution pretty similar for China and the US. And what's your thinking there in terms of, does China catch up? Does it develop its own indigenous technology? Does Xi allow the private sector and free markets? And that's why you've got innovation against the backdrop of all that we're seeing right now. Thank you.
Right, I'm going to still persevere and get the question that I thought I was going to get, which is from the third row. Could you, the gentleman there?
So I wanted to ask, what industries do you think will be most impacted by the AI and technological growth, and with some risks to job security? Is there any way to safeguard these industries?
Okay. So you've got quite a few. There's a very specific on the data and the competition implications, which is an enormous issue, but actually very interesting. But also the sort of modern Luddites who quite reasonably think their jobs are going to be taken and they might get trampled on in the meantime. And the questions, the last question about, well, both the question about India and the question about occupations and protecting them. So take your pick in about, 2 minutes.
Should I start? I think some of them are a little bit linked, especially the kind of backlash and the kind of which industries are most impacted. So almost certainly, yes, there's going to be a lot of talk about how this is going to take all our jobs and how it's going to destroy the human race, et cetera, et cetera. That talk isn't going to stop the progress/adoption unless it feeds through to regulation. And there will be some regulation, but we need regulation. So I suspect that the sorts of adoption curves that we've put up today already took that into account. It is very pervasive. When a technology works and creates money, it's going to be implemented with the necessary guardrails in place. That's my view. And then it's just a question of how fast. Now, I wasn't sure whether your question about which sectors are most impacted was about which sectors are most impacted per se, or where the jobs might be most at risk, because those are two very different questions in the sense that the sectors that we see most impacted by generative AI, for example, are pharmaceuticals, they are software development, and they're customer-facing, like banking and whatever. And in those sectors, there's probably going to be more jobs as a result of this. There's going to be more innovation, there's going to be more demand, products are going to be cheaper, people are going to want to buy more of them. And in fact, there's going to be more jobs. If we think about the kind of broader spectrum of automation, then it's generally the sorts of jobs that Joseph mentioned around very routine manual jobs and repetitive jobs that are most likely to be automated and where the risk of that is the biggest. There are very few of them that can be or will economically be fully automated. It's just not economically sensible to do all of that. But there will be a gradual need for people to reskill. The good news is that reskilling really works. When you reskill welders, or you reskill gardeners, or you reskill nurses, or you reskill, transport operatives or warehouse workers, their jobs become less automatable, their wages go up, their productivity goes up, and it's a kind of real win-win. I'm not saying that we'll be still doing enough of it. There probably needs to be a market
It works, failure. It doesn't necessarily happen.
Correct, exactly. So there will probably need to be policies and incentives and things to kind of make sure that there's enough of it. But I don't see it as a kind of doom and gloom scenario. I think it's very positive, possible, and quite doable to make that transition smoother. I'll say one thing about competitive dynamics, and then I'll hand over to Joseph, which is, it's an enormous question. The latest tech talk is very much about open source models. And Google has its famous memos and whatever saying there's no moat, meaning that, those open source models are actually now performing as well as their models where they spent literally billions and billions training them. And so I suspect that the competitive dynamics will be less about market power and more about competition and innovation that we might fear at the moment.
Joseph.
I'll actually start with a question on measurement of AI effects, because I think it's a very interesting one, and that there is a big difference between the way that we're thinking about AI affecting the economy and the way that the information technology revolution affected the economy. And by that I mean that we are expecting that generative AI's impact is going to operate through time savings and expansion of output in traditional sectors that are already well measured in national accounts. The information technology revolution led to the development of a lot of free goods that the national accounts really didn't know how to capture, and so that led to some undermeasurement. We're actually less concerned about this being a risk for generative AI, and one of the reasons why we think that the impact will show up in the productivity growth statistics and GDP accounts. The adoption backlash, I think that it's a downside risk to adoption. I think that there's a lot of reasons why you could be bearish on the adoption timeline. And so it's something to watch until we've actually seen widespread adoption occur at least any meaningful degree. I don't expect we're going to see much impact in the macro statistics. On the specific questions on India and China, the way that we've analyzed it so far is again by looking at the impact on the labor force and then translating those to productivity effects. For India, they don't have quite as large of a service sector, which is where the biggest impacts from generative AI are likely to be felt. They are a more goods-focused economy. That's why they score relatively lowly. I would also emphasize again that we are kind of bound to the quality of data, and so that if employment statistics are less well measured in India, which I would guess they are, as is typically the case in many DMs or EMs, then maybe that could lead to some bias in our estimates. But broadly speaking, we are expecting that India and other EMs are going to have less to gain from the adoption of generative AI. And the final question on China, it is an interesting, it will be an interesting story to watch play out over the next couple of years, because there has been a surge of investment in generative AI technologies. Again, in our productivity and GDP growth estimates, these investments are not necessarily captured. My guess is that at least in the very near term, we're not going to see generative AI investment rise to a level that's going to really show up in the macro statistics. But if you were to see, wide-scale investment, I think that would also provide an upside risk to our estimates in countries like China, where there might be more of an incentive to develop an organic and domestic AI industry.
Joseph, Tara, thank you so much for answering those questions very succinctly and for giving us such fantastic presentations. Thank you. Right, I'm going to shunt you out, get the young ones in. I think it was Sir Dave Ramsden who said at the start, or said in the course of his remarks, that he couldn't think of every forecast he'd been involved in had involved judgment to some extent. I think at any given time over the last 25 years, it's involved the judgment of Charlie Bean, at least on some of the sort of key forecasts guiding the UK economy over that period, whether as at the Bank of England, overseeing the economic forecast there, or indeed at the OBR. So when I thought that in my head, I thought that was paying tribute to your contribution. It's not an indictment of you that you've been involved in all these forecasts, but you have been doing those key jobs for all this time, and I suspect even though you're only a professor at LSE and chairman of CEPR at the moment, I bet your counsel is still called upon pretty often. We're going to hear from you on how to make economic forecasting fit for purpose. And then we will hear from my colleague, Professor Anna Galvao, who we headhunted from the University of Warwick when we noted that all the other people we were hiring for our modelling team were citing her papers in their interviews. She wrote it as a professor of economic modelling. She's written some pretty seminal econometric papers. But Charlie, we're going to hear from you first.
Thanks, Stephanie. You've actually been very kind about my age. So it's not 25 years I've been doing forecasting. It's actually...
I was only blaming you for the forecast of the last 25 years, because you were in charge.
I actually go back 50 years.
But you weren't necessarily calling the shots.
Well, I wasn't calling the shots, that's true. I can blame the Chancellor for forecast errors by the Treasury back in the second half of the 70s, but I was actually engaged on the forecast team as my first professional job. Now, the exam question that we've been given is how to make economic forecasting fit for purpose. Now, the context for this is obviously Ben Bernanke's review of forecasting at the Bank of England, forecast processes. It's not narrowly on what went wrong with a particular forecast, but the way the forecast is used and communicated, and a much broader question. I'm going to come back to economic forecasting later, but I want to start with weather forecasting. Now, I mean, some of you might have seen a play called Pressure by David Haig that was in the West End a few years ago, which tells the story of D-Day and the advice given to Eisenhower by two different meteorologists, one American, one British. They had conflicting views, and this is a true story, on whether there was likely to be a break in the bad weather to enable D-Day to go ahead, with the American essentially basing his views on just past patterns being repeated, whereas the Brit understood much more about the details of what was going on in North Atlantic weather systems and so forth. And of course, the Brit was right and everything, but it emphasises the degree of disagreement and uncertainty there was about weather forecasting at the time. And indeed, when I started as a lad at the Treasury back in 1975, weather forecasts, even for the same day, were still pretty unreliable. These days, weather forecasts up to a week ahead or more are generally pretty reliable, at least in a probabilistic sense, and the weather forecasters try and attach probabilities to chance of rain and things like that. So there's been massive improvements in weather forecasting in past decades, and that reflects several things. Firstly, better input data on things like temperature, air pressure, at numerous points on and above the Earth's surface in the atmosphere, and including information from satellites. Better understanding of the meteorological processes that are at work, and in part that's based on a large volume of past experience. And then a vast expansion in computing power, because the way that forecasts are constructed, if I understand it correctly, is essentially by taking complex nonlinear dynamic systems that represent the way weather systems work, inputting current conditions and then perturbing them slightly because they're not perfectly measured and so forth, and doing multiple runs of that. So it's a sort of variant on stochastic simulation, but not where future shocks are particularly important drivers. So that, we've got to where we are with that, with those improvements. Even so, Google has just in the last few days claimed that AI, which we've just been talking about, and in particular their meteorology model, GraphCast, which uses a graph neural network, can provide even more reliable forecasts than conventional approaches out a week and more. So the question is, can we expect to see similar advances in economic forecasting? Now, I do think there's scope for new sources of data to improve our grasp of where the economy is at the current juncture. A large part of what policymakers do is discussing where the hell have we been and where are we at the moment before they even get into where the economy might be going. And you can see sources of data, big data on things like payments, scanner data, admin data from within the public sector being exploited to give more timely reads on what's happening. There's new surveys. The ONS introduced the business interruption from COVID survey, which they've continued with under a different name, but helpfully the name, which I can't remember, still spells BICS. So it's, all you need to remember is BICS, which again provides up-to-date information. The bank's decision maker panel is another source. There's also been work in academia establishing long back runs of historical data. The Bank of England's Millennium of economic data is a good example. I was just reading a paper the other day which referred to some data set that's been constructed for 9 countries with annual economic data going back to 1300. So, you know, you've got this explosion of historical data as well if you want to use it. And there's potentially scope for applying artificial intelligence to these data sets. That said, I'm skeptical that we're going to see improvements to economic forecasting, anything like those that we've seen with weather forecasting. And there's several reasons for that. Firstly, even with the new data sources, the evidence base is not that rich. You know, there's loads of hurricanes that we can study in the past. There's only limited numbers of their economic equivalents, financial crises or whatever. But more importantly, the object of study is continually evolving. The economy today is very different from that of the early post-war period, and even more so from that of the Victorian era. Obviously shifts from agriculture to manufacturing, then to services, big changes within them. Again, AI, which we've been talking about, presents scope for further substantial changes in economies. Then you have the institutions that govern economic behavior changing, evolving over time. Importantly, agents respond to the associated shifts in incentives. You need to understand those and take them into account, essentially the Lucas critique. And then finally, you've got exogenous non-economic shocks like the pandemic, the war in Ukraine, which are a key feature of the economic landscape and for which there's no real analogue in the meteorological sphere. Obviously, there are changes there associated with climate change, but they take place on a slower time frame. So I think you're going to be stuck with where we are, or something like it, for a considerable time to come, if not forever. So let me make, to begin with, a few sort of observations about economic forecasts. I'm going to come to some proposals at the end. The first issue with forecasts is, I think, a problem of language and a disjunction between the way economists think about them and the way the public and the media think about them. It's summed up in Niels Bohr's famous aphorism, prediction is very difficult, especially if it's about the future. And the problem here is really a problem of language. The statistical models that we use and learn about in econometrics and so forth basically can be used to derive measures of central tendency for a projection over repeated samples. It's like throwing a pair of dice. You can get, obviously, any outcome between 2 and 12, and you can calculate the probabilities of each of them. But any one throw can't be guaranteed to throw up the central expectation, which is a 7. Only in large samples do you get more 7s than other outcomes either side. However, the general public, the media and politicians expect forecasters to be able to foretell the future in the sort of way of Mystic Meg. The specific outcome, you should have been able to predict it. And they think that's what economists do. Of course, the way economists think about this, that you can use models to generate a measure of central tendency, which will be true on average, but will have deviations either side in any specific instance. The way they actually get described is as forecast errors. And here the textbooks are at fault by actually calling them forecast errors. But unfortunately, back to the general public and the media and the politicians, they think of those errors as indeed errors, where the forecaster or the policymaker, as it is in the case of the Bank of England, actually failed. They failed to predict something which is essentially unpredictable. And the problems become especially acute when you're in a situation of, call it Knightian uncertainty or radical uncertainty, which several people have already mentioned this afternoon. Environments where it may be difficult even to foresee certain sorts of events, and certainly there's no basis for attaching probabilities to them up front, although it's very difficult to attach probabilities to them up front. And I have to say, I think the recent experience of central banks and the spike in inflation, and the Bank of England in particular, is an illustration of this. I think it is unreasonable to expect the MPC have been able to predict that Vladimir Putin would have invaded the Ukraine and what its consequences would have been for oil and gas prices and food prices and so forth. I should say I don't acquit the MPC entirely, because I do think they made policy errors during the pandemic by maintaining asset purchases longer than was appropriate, significantly longer than was appropriate. But the bulk of the inflation spike surely has to be attributable to that essentially unpredictable event. Nevertheless, you do get in public discourse and in some politicians' pronouncements criticism of the bank for failing to see this inflation coming and to head it off. I should say, even if they could have seen it coming, it's pretty difficult to see how they could have headed it off without a very substantial squeeze in activity, because it requires non-energy prices to fall by about 10%, given the scale of the rise in energy prices and the share of energy in the household consumption basket. And you probably wouldn't have wanted to do that anyway. Now, I'm going to come back to all of this issue with uncertainty towards the end. How am I doing on time? Right. I want to say a few quick words on models. The models that forecasters use need to reflect circumstances and the purpose for which the forecast is constructed. Purely statistical models, vector autoregressions, things like that, they're okay for straight, unconditional forecasting in stable environments like we had during the Great Moderation. They're not very useful for analysing puzzles where things are changing rapidly in the economy, things that you don't really understand what's going on, unexpected developments and the like. There you do need structural models. Traditional macroeconometric models, we know the criticisms of them, that they're big, not always easy to understand, impose implausible identifying assumptions and the like. And for that reason, academia has gone off and embraced dynamic stochastic general equilibrium models, which are tightly specified theoretical models, which are then calibrated to the data. It's best to think of those as laboratory models. They have a use in academia, but central banks have rushed to embrace them. And that includes the Bank of England, as its sort of primary model is a DSG model. Now, in principle, you might think these sorts of models are useful for thinking about changes to the structure of the economy or unanticipated developments and so forth. But in practice, that does require very highly trained staff and a good IT base. And one of the key things I'm going to come back to at the end when I talk about scenarios is the ability to actually use them freely. And I think there is a question about whether DSG models are suitable for that. What's also important is the way the forecast is used. The forecast at the bank plays several roles during the forecast round. It starts as an information processing device at the beginning of the round for updating for new information. Then it becomes a quantitative vehicle for the MPC to discuss the key issues, the key challenges and uncertainties in a quantitative framework which provides some discipline. Then as you get nearer the end of the forecast process, it becomes a vehicle for helping the MPC think about what the right policy decision should be, an appropriate policy decision. And then finally, after the decision is made, it becomes a key vehicle for communicating with the wider public, the markets, the media, and so forth. And those multiple purposes create tensions in the process. People who've been on the inside will know what I'm talking about, and they'll understand why the tensions arise. Outsiders, it may not be immediately obvious, but it is an issue. And I think probably an issue that Ben will have been grappling with and talking about the people he's interviewed while he's been over here. One of the things that's distinctive about the bank's forecast is it's collectively owned by the MPC, the best collective judgment, as it's called. Now, many other central banks don't do that. They just have a staff forecast that's published. And it is possible that this is something that Ben may end up recommending. Certainly Dave Stockton in his review about a decade ago suggested it. I have to say, replacing the MPC's best collective judgment, difficult though it might be to arrive at, I think it would be, and replacing it by a staff forecast, I think would be retrograde, because the staff forecast is just an input. Outsiders want to know what the committee think, committee members, the policy makers. At the OBR, where I also spent 5 years recently, the role of the forecast is somewhat different. It's, above all, it's a disciplining device to prevent wishful thinking by the policymaker, who is here, the Chancellor. That's why it was deemed sensible to take the forecast away from the Treasury and give it to an independent agency. What it's also seeking to achieve is more transparency in the public finances, which is why a lot of detail about what's going on in the public finances is contained in OBR reports. Importantly, what the OBR is about, in a way that is not so true with the bank, is it's not just the range of most likely outcomes, but also needs to shed light on the risks to the public finances. And indeed, it actually has dedicated publications. It was the Fiscal Risks Report and the Fiscal Sustainability Report. Those two were separate. They've now been combined into one. But the Fiscal Risk Report, in particular, does what it says on the tin. It is an analysis of potential shocks to the public finances. And a key thing about the public finances is the shocks that they're subject to are typically very asymmetric. So basically you have bad times when deficits and debt goes up. Wars, financial crises, pandemics, and so forth. And optimal policy, optimal intergenerational sharing, suggests that the appropriate policy is to let debt and deficits rise in bad times, and then you consolidate in good times to build up the fiscal space for the next bad shock when it comes along. And in principle, in designing fiscal rules, this is something that you need to factor in, the likely size of these adverse shocks, the likelihood of them crystallizing, their impact on the public finances, and so forth. And that determines how rapidly you need to consolidate when the bad times are past. Now, governments have no problem at all in saying, let's spend more in the bad times. They're not so good in consolidating in the good times. And I have to say, current fiscal policy falls well short of what's desirable. There's lots of other issues with the fiscal rules as well, that they don't take account of assets, focus on debt, and obviously what Dieter Helm was talking about was relevant to that. But the importance of risks is something I'd flag in the fiscal space. Now, what's to be done? Okay, I have got a couple of things I want to suggest. First, we need to tackle the problem of uncertainty, and in particular, communicating uncertainty. Now, policymakers and the MPC in particular have no problem in admitting there's uncertainty. You'll find inflation reports, and these days monetary policy reports, often carry the phrase, "These are unusually uncertain times." I've never once seen anything that says, "These are unusually certain times." But plenty of formal acknowledgement that it's uncertainty. But in practice, what happens is, despite saying that, there's lots of risks, and actually there's lots of textual discussion of risks in the monetary policy report, for instance, most of the subsequent discussion in the media and in the markets tends to focus on the central projection. And I think that's unfortunate, particularly when you have sort of things like the Ukraine shock or the pandemic, because the chance of the central projection becoming true is negligible. It could be well off, but that's not an error. It's something that is quite reasonably to be expected. And basically, you need consumers of the forecast, not the policymakers, but outside consumers, to understand that uncertainty. Now, the bank obviously tries to communicate that through fan charts, as in, the OBR also uses fan charts, and they become quite a widely used pictorial tool. Now, I have to say they're very well intentioned, but I've come to the conclusion that they're a heroic failure, because they don't really get the consumers to treat the uncertainty seriously. People just go back to looking at the central projection and saying the bank has predicted inflation of 4.6 or whatever it might be out at the 2-year horizon. Now, what I don't suggest is dropping fan charts, but the thing that's lacking, I think, to the wider audience is a story that underlies what's in the fan. A lot of the text of OBR publications and MPC publications is about the central view and the economic story that underlies it. And what we really need to do is complement that with narratives for the off-central path. And scenarios, which have already been mentioned today, I think are the way to do that. The OBR does in fact use scenarios in its economic and fiscal outlook alongside fan charts. And the fiscal risk report, as I've already said, is basically a publication of loads of scenarios for different possible risks. But I think the MPC would be wise to embrace this. And this allows you to look at a whole raft of things where you might want to expose to the wider public why things might turn out differently from the central view. So this may be different conditioning assumptions. The MPC is typically loath to change its normal benchmark rules for future projections of things like commodity prices and so forth. But there are occasions that the standard approach may not work well. Be willing to embrace alternative conditioning assumptions when it makes sense. And, you may want to do it as a scenario as opposed to putting it into the central view. But at least outsiders can then understand the consequences of those different assumptions. Similarly, there's the possibility of exogenous shocks that you may want to expose. What happens if there's another big hike in oil prices because of the current configuration in the Middle East, for instance? Again, scenarios can be used for that. And I think most importantly, they're a way of illustrating the consequences of uncertainty about the way the economy operates. I think one of the mistakes that the committee made was to underestimate the degree of inflation persistence from the external inflation shock that would come about through the labour market, not through forward-looking inflation expectations, but by workers wanting to protect their real living standards and equally firms wanting to protect their profit margins. Now, this is something that back in the 80s, when I started the academic part of my career, we understood was an important part of the inflation unemployment story. Then we used to refer to it as real wage rigidity. These days it seems to be called catch-up. But you can use scenarios to illustrate the consequence of what happens if the economy behaves in a different way from what we've assumed. The MPC assumed on the basis of post-92 experience those forces wouldn't be there, but that was a judgment that might have been reasonable, but you can illustrate the consequences of alternatives. The important thing is that the scenarios chosen are meaningful and provide alternative narratives that help outsiders grasp the nature of the uncertainties that policymakers focus. The second thing I would recommend is more overt learning from past outturns and where they've deviated from central views, central projections. Actually, the OBR produces an annual forecast evaluation report which does this. Latest edition, 61 pages, ain't short, goes into a lot of detail, deconstructing the sources of why the forecast and the outturn differed. So how much of it was down to data revisions, how much down to the conditioning assumptions on things like commodity prices being wrong, how much down to inappropriate economic judgments on the part of the Budget Responsibility Committee, who take ultimate responsibility for the judgments and the forecast. Now, I should say the OBR don't do this because they're enlightened. The OBR does this because the law requires them to do it annually, but it's actually, I think, a very good discipline. The bank, I think, would benefit from doing something more systematic on forecast errors than it has tended to do in the past. There's occasionally been bits in inflation reports and now monetary policy reports on this, but a more regular evaluation of past forecasting errors I think would be helpful. It probably would require the bank to provide more granular detail in its forecast to make that possible. The one thing I wouldn't look to do is be providing more guidance on the future path of policy itself. Forward guidance was probably a necessary evil while interest rates were at their effective lower bound. But before we got there, Mervyn King, when he was governor, whenever he was asked at the press conference what's going to happen to interest rates, he'd say, I don't know. Your guess is as good as mine. It all depends what happens in the economy. And this fact that the interest rate decisions depend on the data on economic outturns is key. The bank and the MPC don't have privileged insights into what's going to happen over the future, and trying to say where interest rates are going to peak, when they're going to fall, I think really is setting policymakers up for a fall. And we've seen examples of that in the past couple of years. And policymakers would do well to resist getting sucked into saying, for instance, I think it's reasonable for you to think that interest rates might fall in the second half of next year, as Hugh Pill did, I think, last week. I think misleading, or apparently misleading forward guidance actually has damaged central banks' credibility. So the unreliable boyfriend epithet that was attached to Mark Carney is an example of that. I think probably damaged his standing somewhat. To look across the other side of the world, Phil Lowe, the governor of the Reserve Bank of Australia, failed to get reappointed for a second term, essentially because he had promised rates would stay low and then had to raise them when there was the global inflationary shock. It follows a fortiori, I should say, that I'm not a fan of the Fed's dot plot, which ends up focusing on small differences between policymakers. Much better for MPC members to focus on the economics and why they differ. Finally, I want to just conclude with a challenge, which is not really a challenge for forecasts, but for how they're used. The essential problem, I think, that people find frustrating is that policy, whether it's monetary or fiscal decisions, are tied quite tightly to forecast outcomes of the future, 2 or 3 years ahead in the case of the Monetary Policy Committee, 3, 5 years ahead, whatever it might be, in the case of the Chancellor. And there the projections obviously refer to deficits or debt, whatever is in its fiscal rule. Now, policymakers need to be forward-looking, but the problem is you're making the decision hinge quite tightly on what are potentially quite flaky and debatable forecasting judgments. And the question is, how do we devise appropriate policy rules, policy reaction functions, if you like, which make them less sensitive to these precise forecasting judgments, yet still maintain some forward-looking element. Now, I emphasize this is not a problem for the forecast, because I don't think forecasts will ever be able to be rid of this residual uncertainty, but it is a question for policy design, which has worried me throughout my time as a policymaker and an economic forecaster, and I still worry about it. And one day somebody might solve the problem and come up with a solution. I'll stop there. I've probably overshot badly. I'm a terrible forecaster on time.
Anna.
Okay, so that was the task that was asked us to think about it. I'm somehow think quite similar to what he just said. So the way I'm going to do is I'm going to think about what's the purpose of economic forecasting. I'm going to look at 5 of them and come with some suggestions based on that. So the first one is that what we do as economic forecasters is to forecast key economic variables, and what you want is accurate forecasts. Okay, so what you want is to minimize the word that he doesn't like too much, the root mean square forecast error. Now, if you see these plots that you have in there, they are from one of the apps we have in the terminal. And what you have is a comparison of the relative performance of the forecasters that answer the survey. And also there is a forecasting model there in the middle. So if you see, you have on the left forecast for US GDP. On the right, you have forecast for your area GDP. And you can see you have a variance on performance across different forecasters. But interestingly, you can see that the BE nowcast, which is a statistical model, is somehow to the left. So it has better forecast performance than many of the other forecasters, and is a bit to the right for the Euro area GDP. So I'm showing this because in the academic literature, we also know that in particular for very short-term forecasts, the use of judgment or the use of additional information normally builds up on the statistical models because they use such a narrow information set that adding information usually helps. So this is one of the things. So if your purpose is accuracy and short-term forecasting, I would say start with a statistical model and maybe add some additional information. I think that normally is the kind of way you get good accuracy. But we know that it's not always the purpose of economic forecasting. Additional purpose is actually to measure what we learn from the data. So what you have in that plot there is two different surprise index. What they measure is what we learn from the releases of US data. And you see you have a growth index and an inflation index. The numbers are positive when the data has been higher than the consensus forecast. So here we're using forecasts, in the case the ECHO survey done in Bloomberg, to measure what professionals knew before seeing the data. And then we use the surprise as a way what they learn when they see the data. And you can see that varies over time. Sometimes the data is higher than the forecast, sometimes it's low. But the forecast can be used to get what we learn from the data. And why this is important? This is important because this has consequence for financial markets. So here at Bloomberg, we have a model that you can use to predict what's the likely impact from surprises from the data releases on the yields. And we actually find out based on the model that they can have quite persistent effects. So the plots you have in there is the consequences for yields of 2-year and 10-year maturity for the US. And you can see that goes up to 2024. And what we're trying to show is what would have happened if you have a surprise on the CPI release. So we have a CPI release last week that actually was early this week that have a quite big impact on the market. But that one is the persistent effect over time. So this is other purpose of forecast. Another one, and also Charlie mentioned that one, is to build scenarios, okay? So you're in the business of building medium-term forecasts, so it's not short-term forecast I was talking before. And then to do that, you might want to consider the impact of shocks. And what you have in front of you is one of our apps in the terminal that's called Shock that allowed you to input some visions about some shocks and see how that would change your baseline forecast, okay? You can actually input your own baseline forecast if you don't like the one you have in there. But the idea here is to use shocks to build different scenarios, okay? The interesting thing here that the kind of technique we use to do that is a structural model because you need to be able to figure out what's the impact of all that exogenous variation in that plot there on UK GDP growth. So I think this is a good use of some of the ESG models. Actually, the model that does this, that's behind this app, is a semi-structural ESG model. And this is what Charlie has been talking a lot, which is the fund charts from the Bank of England. I pick up two there because I want to show how they can be used to do something else, which is to communicate policy. So the one on the left is the views of the Monetary Policy Committee for May 2016. The one on the right is 3 months later, the views of the Monetary Policy Committee for GDP for August 2016. You can see how beautifully different they are. So the one on the left has, you see, if you look at the green part, you have this 2% growth, kind of almost constant there. The one on the right, you have this decline that goes to almost to zero. And that one on the right was used to cut rates. And what happened in between was the Brexit referendum, and there was lots of uncertainty in financial markets. And by measuring the likely impact of that uncertain GDP with that plot, this was used to communicate a cut in rates. So this is one purpose. But you can see that, as Charlie said before, this also is used to measure the uncertainty around the forecast. But there's other way that the MPC actually communicates that uncertainty, which is what I'm trying to show in that plot. So actually we heard from early today that the MPC has an even balance of risks, right? So now, for example, there is higher upside risks to inflation than downside risks. And the way this is make it public is because you can look at the skewness of that fund chart. For your eyes, it's very hard to see, but there is a spreadsheet published in the Bank of England website that has this skewness, and actually you can see the skewness over time since 2004. And in that plot, I'm showing the standardized skewness for growth and for inflation of the 2-year ahead forecast. So the interesting thing there is loads of time variation. So for example, during the Great Recession, the MPC was embedded loads of negative downside risks to GDP. And you can see as well that for inflation, sometimes you have upside risks and downside risks. The interesting thing here is that if you correlate that with the number of MPC members that have dissident voices, which means that they didn't vote with the majority, you can see that if you look at the inflation in particular, you actually find a good correlation. I don't know the causality though. I don't know if it's because you don't know about the risks, you know, it can be tilted one side to another, that the committee disagree with each other, or if the disagreement is reflected on the fund chart. But that's the kind of information you can get. Now, this is the last one on communicating uncertainty. So I strongly agree with Charlie that communicating uncertainty is very important. We forecast not always get right, and we need to get around saying that that's the case. But what I'm showing to you there is actually from the New York Fed. They have something that they call outlook at the risk. And the plot on the left is bonds over unemployment. So it's a kind of a 4-quarter horizon of the average unemployment. And what you can see, the black line is actually the observed unemployment rate. And you have then, 5 other lines. The red one is the median. So there is a 50% probability that that's going to be the number. And then you have blue intervals and, maybe a gray intervals. Now, the important thing here is that you can see that there is loads of time variation over time. So this is actually quite in contrast from the Bank of England flow chart, that I show you the skewness varying a lot over time. But if you look at the uncertainty, it doesn't change too much, because as he said before, it's very hard to say, oh, now we are less uncertain times. But that plot there is based on a statistical model. A statistical model doesn't have political problems, right? So a statistical model can capture pretty well the time variation of uncertainty. So you can see that sometimes the range there is higher. I think in 2011, 2002 is higher. During COVID is higher, but sometimes it narrows down, okay? So my view, and actually if you read the academic literature on this subject, is that while judgment, which I started my story here, is helpful for short-term forecasts and to come with the central tendency of the forecast, when it comes to evaluate the uncertainty around forecasts, we probably need models, or we need to evaluate our own forecast performance. That's another thing that Charlie told us to do. So either way, but we cannot just look at the sky and come up with a measure of uncertainty. Another comment I want to make is that on the left-hand side there, you also have two densities. So there are forecasts, I think, based on information of October. And you can see that the advantage of having this density forecast is that you can talk about the tail. So you can see that the blue line there, the blue bell curve, if you want it, is fatter than the red one. And what that thing means is that now the tail risks for unemployment for the US are higher than have been historically. So that's the kind of thing one can do with statistical models. So let me just finish, because I know we're running late. So my main takeaways here is the following. I think you can use statistical models to summarize data for short-term forecasts. Here at Bloomberg, we have nowcast models that process loads of data. For some countries, you have more data than others. And I think models are good in doing that. But at the same time, I think it's very important. I do believe on the expert judgment. During COVID, for example, the statistical models were completely lost. I mean, there was no lockdown bottoming then. And of course, judgment is much better in that case. I think it's important, and this is part of the forecasting process that was describing for the bank earlier, that you can use forecasts to figure out what you learn from the data. So you can use forecasts to figure out the forecast revisions, and they might be important. So one way to think about the uncertainty of the Bank of England is also maybe you can start talking about, how the uncertainty has been changing over time. And other thing too, as I told you, I think structural models still have a role. They have all the problems that have been discussed before, but they still don't a good way for us to figure out how to build scenarios, and also to help us with medium-term forecasting. And finally, I think it's very important to measure forecast uncertainty. I think subjective uncertainty is normally not a good idea. You should look at your past forecast performance to figure out how well you might do in the future, or you can use a statistical model to do it.
Anna, thank you. Thank you very much. And I appreciate you have, for the interest of people getting out for their drinks and for the final section, you squeezed your session. So
Yeah.
I do appreciate that. Can I just check that whether George Parker's here? He's. I was looking for you. Are you okay if we take one question? Cool. Because you. Well, there's a few more than one. All right. Well, I'm not sure we can take all of these, but your hand was up first, and then I'll take a couple of those. But let's take.
Thank you, Danae Kyriakopoulou from the Bank of England. So you spoke a lot about the technical challenges with forecasting in terms of getting new sources of data or improving statistical models, etc. But what about the adaptive challenges? And yet one thing is communication, but for economic forecasting fit for purpose, we also need economic forecasters fit for purpose. And for example, you spoke about DSGE models being used a lot in central banks and at the bank. How do we convince, if we find that, for example, they're not fit for reflecting climate change or any other issue, that all of these economists that we have who have built their doctoral thesis, whether at the LSE or elsewhere, learning about DSG models can kind of give them up or work with other types of models and forecasts? Thank you.
Can I also so I'm going to take here at the front and then right at the back. I'm just going to,
Thank you. Azad Zangana from Schroders. And Charlie, I absolutely agree with you about the love for the fan charts, or the lack of love for them, and strongly advocate using scenarios. But where I disagree with you is I think actually the fan charts should be killed off and instead move to discrete multi-scenarios. And this is something we did at Schroders over a decade ago when the world just became a much more complicated place. Now, unfortunately, that means no more beautiful bell curves anymore, because that just simply doesn't work. But instead, you have tangible scenarios that people can put probabilities on, people can understand and interpret, and then we can then really think about tangible risks for the economy or for policymakers. Thank you.
I'm interested to how you think, I don't know, the BBC economics editor would be able to put that on the 10 o'clock news, but we can discuss that later. All right, question there.
So we've moved from a nice world, I think that's also a term that Charlie coined at some point, to one of great macroeconomic volatility. Does that mean that policymakers should put less weight on forecasts and more weight on current data? And I guess also, does that also mean that policymakers should use, perhaps from a judgment perspective, much more conservative assumptions about the future, including worst-case scenarios, again, rather than just relying on statistical models?
Okay, quick. Take your pick. Anna, you start.
I think I want to talk about, she was talking that the economists are trained in a very specific way to think about forecasting that does incorporate climate change. I think she has an important point there. You saw that most of my analysis was medium-term forecast, 3 or 4 years, and I think for climate change, we need to improve our knowledge to do 10, 20, 30 years forecasting. In that case, I think we worse than short-term forecast, and you clearly have a point that we should develop models that accommodate a longer-term view about the economy. Most likely might not be DSG models, but there are other ways that you can, because what the DSG models does for us is to figure out the effect of something, a variation that's exogenous on a system, right? It might be different ways to do that. But I think that's an important point, and I think it's something to think about for the future.
Charlie, do you want to respond on the scenarios and the one?
Yeah, I mean, just on the first of those, about sort of adjusting models for new features, and the key is that the staff and the internal technology have to have sufficient flexibility to be able to respond to those. So you need good economists to be able to work out how to incorporate new features and stuff like that. But it also takes time, potentially. I think, and it was why I made the remark about DSG models, that I'm not so sure they are as well suited for constructing lots of scenarios in a forecast round as perhaps traditional macroeconometric models might have been. It's an open question, but that flexibility, I think, is central. Well, as I said, I would not kill off the fan chart. I think there is an argument for making it mechanical. So the MPC's fan charts are supposed to be the MPC's subjective uncertainty. It's informed by past forecast errors, but the OBR is mechanical. It's just average of last decade's worth of forecast errors or whatever. The virtue of that is at least you know what you've got, and you can say, well, we think we've moved into an era of greater uncertainty, and this is why, and you can use your scenarios for that purpose. I'm not sure what killing off the fan chart actually really achieves. So as I say, for me it's a compliment, but the key thing is providing economic narratives for how things may turn out, quantitative economic narratives, for how things may turn out differently from the central view. As regards the question about how you change policy, should you put less weight on forecast, more on current variables? I think this is a tricky question. It's sort of what I raised right at the end of my remarks. In some sense, it's not a problem for the forecast, it's a problem of how you use them. What you really want is some approach which is robust to that forecast uncertainty. But I think this is something where somebody has yet to write the paper that unlocks it. It's a challenge, and as I say, it's troubled me all the time I was at the bank and when I was at the OBR. It obviously troubles the Chancellor when he's asking how many billions have I got to play with in the autumn statement. And it's contingent on some forecasting judgments by a committee, which there's a lot of uncertainty around them. Reasonable people could take different views and so forth. But you don't want to go to a world where you completely throw out the forward-looking element. So somehow or other you need something which has a forward-looking element but is not so sensitive to the niceties of forecast judgments. Now that may mean having some buffer area, so it's like having a target range instead of a point forecast for inflation, but there may be other ways. But as I say, I think it's an open analytic challenge about how to deal with this.
Can I just make a comment? We saw earlier today, actually, there was a range of forecasts that depend on different models, right? So one thing we could think about as well is how to communicate that and how to use that kind of information. For what the bank seems to be using that is the fact that they have a range of forecasts for inflation and use that to figure out asymmetric balance of risks, which I think is an interesting point to take into account. And I think when we think about in robust forecasting, I do think combining most likely the forecasts from different forecasters or from different models. This is normally a good way because there is always a model that does better in some cases and a model that does better in some other cases. And the model combination is normally one way to get more robust forecasts.
I mean, it may not be known to people in the audience, but the bank actually has a suite of models that it weights together in a mechanical fashion as a sort of cross-check on the MPC's forecast.
Charlie, Anna? Thank you so much. We're going to move swiftly on for our last session. But that's all right. Right. Well, we've studiously talked about policy for the afternoon and not politicians. So we're going to insert some of the politicians and the politics in this last session with George Parker, who's managed to be. He's got two great achievements. He's managed to be political editor of the FT since 2007, and he's managed to, throughout that time, be considered the nicest man in the lobby, potentially the nicest man in Westminster. Who knows? Although he's proved that also by kindly sitting while we went slightly over, waiting for his session. But you're going to talk for, how long do you want to talk?
20 minutes.
20 minutes,
and then
okay.
open up for
and
questions.
then we'll have a conversation. Brilliant.
Thanks, Stephanie. Thank you very much. Stephanie, thanks very much for having me. My two children, who are economists, think it's highly amusing I've been invited to address your august gathering. I did human geography at university, so they think it's highly unsuitable. But I am here to talk about the grubby world of politics, subject which I do know a little bit about, as Stephanie said, after having somehow survived as the FT's political editor for over 15 years now. And I'm just going to talk a bit about how economics is going to play into the next election and the dividing lines that we might or might not see opening up between the Conservatives and Labour as the election approaches. It's axiomatic that elections are decided by economics by and large. And if you look at the issues that the voters say they care most about, they have these regular tracking polls where they ask people to name the 3 issues they care most about. The economy always comes top, or cost of living, or some area in that, some phraseology in that area. One poll I saw today was that the economy is rated by voters, 55% of voters listed it as one of their top 3 concerns. Health, 44%, immigration, 37%. And that's been a fairly consistent pattern through this parliament. It's the economy, the health service, and then immigration or small boats. And then somewhere below that, the environment, slightly coming up on the rails with sewage and rivers and so on. And then housing as well, another subject which is rising up the salience issue. But nevertheless, the economy will be at the front and centre of the next election. When you speak to Rishi Sunak's strategic advisors on the election, they all say it's all very well talking about culture war issues or indeed the boats, but in the end it's going to come down to the economy. And with that in mind, I was just checking out the latest polling on which party polls best on the economy. And there's conveniently a poll out today by Redfield and Wilson, which puts the Labour Party ahead of the Conservatives on every single issue that they were asked about. And on the economy, Labour were leading the Conservatives by 35 to 25 points. And plainly, that's a reversal of long-term trends. You can track a lot of that back, of course, to the events of a year ago, the chaos of the mini-budget. And I think one of the big determining factors of the next election will be whether that Truss mini-budget is as searing an event in the public's imagination and memory as Black Wednesday was for John Major's government. The difference with John Major's government, of course, was that after Black Wednesday, they ran a pretty effective economic policy under Ken Clarke and delivered to Tony Blair economic prosperity and growth. The problem for Rishi Sunak is that although he stabilised things after the Truss budget, the general perception, I think, over the last few months and indeed over the last week will be one of general chaos rather than necessary competence. And that feeds back into a loop about whether you can trust them on the economy if you can't trust them, for example, to run a competent immigration policy. So, Labour ahead on the economy. However, and you'll have been talking about this in your conference, I think one of the interesting things about the economic debate in the next election is just how constrained it has become by economic reality. And I really felt that at the party conference season this year, where you felt that everything was closing in on the politicians. It felt very claustrophobic. The debate on the economy felt like the choices were being narrowed down. And you know better than me, or at least as well as me, the things that constrain the highest taxes for 70 years. That puts higher taxes basically broadly off the agenda, at least in terms of what people are prepared to talk about before the election. Debt at almost 100% of GDP, putting the brakes on higher borrowing. Fiscal rules, basically, Labour are adopting the same fiscal rules as the Conservatives, which puts a massive brake on higher spending. And then, of course, you've got the terrible state of the public services, notably the health service, but many others, which makes it very difficult to deliver tax cuts. You end up with this very sort of narrow political debate on the economy, and you really felt that listening to the respective leaders' speeches at the conference. You know, Rishi Sunak's speech, if you remember back to that, the main centrepiece of it was scrapping HS2, and then a couple of cost-free or largely cost-free measures on phasing out smoking and reforming A-levels. And think about Keir Starmer's speech. You know, this is probably, possibly, the last party conference before the election, the moment you expect to see a big barnstorming, raising of the blood speech. The centrepiece of it was reforming the planning system, supply-side reforms. And it's not the kind of thing that, you know, stirs your socialist blood, frankly, reforming the planning system. It's important, but it really sort of rammed home to me just how the big political choices of tax and spend, they've been narrowed off by economic reality. And all the excitement at the party conferences was basically taking up place on the fringes, the place where the activists got really excited, whether it was Liz Truss banging on about unfunded tax cuts again, or on the Labour left, you know, talking about unfunded spending increases. So things are going to be tight, and Keir Starmer's instincts plainly are to play it safe. Now, I've just spent the morning actually writing a sort of FT analysis piece with Sam Fleming, our economics editor, about the idea of a stagnation nation and how over the next 2 years at least we're going to be suffering pretty flat growth and well below historical trend growth, beyond that according to the Bank of England at least. And that's really the economic backdrop to the autumn statement next week. The political backdrop is the fact that the Tories are 22 points behind, also on average, behind Labour in the opinion polls. And those are the two challenges which Jeremy Hunt will have to address in his autumn statement next week, the economic bit, which frankly at the FT we think is the more important bit, and then the need to throw some sort of political lifeline to a load of Tory MPs who fear unemployment and are currently spending their time walking around the City of London with their CVs thinking about a post-political career. And I think the idea of this idea of a stagnation nation and the fact that everyone agrees with Liz Truss that growth is the issue, even if she didn't quite get right the response to that, it's forced everyone to become slightly technocratic in the way they talk about politics at the moment. So I think that's going back to the party conferences, and that's what we saw. So if you look at the stuff that we're going to see in the autumn statement, what things we know about in the autumn statement, and Jeremy Hunt's going to say it's all about generating growth, there's going to be stuff which frankly is pretty non-political, non-partisan, things that the Labour Party will be able to sign up to. He might extend or even make permanent full expensing, for example. He's going to have a plan to improve connectivity to the grid for green energy projects. There's going to be more money for the 5 key sectors he's identified. There's going to be pensions reform to try and get more money into startups, probably ISA reform as well. All these things are important in their own right and technical things, but not the kind of things that cause massive political division. And Jeremy Hunt's key priority next week is to try and persuade the OBR that the things he's going to announce in this autumn statement will be able to nudge up the growth potential of the economy, as the OBR did back in the spring budget. Where there are slight differences between the two parties on the supply side agenda, I mentioned earlier Starmer's speech on planning reform. Now this is something which the Conservatives talk about, but have obviously run scared of ever since suffering a number of by-election defeats in the home counties, particularly in Cheshire and Amersham, but many other places as well. And it's really interesting. I think this is one of the big political dividing lines that Starmer's making, often seen as rather a sort of cautious politician. You know, being on the side of the builders, not the blockers, is actually a really important supply-side message. Whether he actually sees it through is another question. I was up at the Mid-Beds by-election, which Labour ultimately won, but you could feel very strongly the way the Tories were campaigning on, you know, Keir Starmer's going to build on every bit of green land in your area, and it was an effective message that was coming through. The second bit, where there is a big split on the supply side agenda, is on Labour's promised £28 billion a year of borrowing to fund their green prosperity plan, something that Ed Miliband has been promoting, something which was conceived in an era of zero interest rates, and which now is looking, frankly, a bit of a liability politically for Keir Starmer. And what we've seen over the last few months is a gradual edging away from that £28 billion figure. First of all, it was going to happen sometime, they were going to hit the 28 billion of borrowing sometime around the middle of the Parliament. Then it was pushed back towards the end of the Parliament. In fact, things were going to ramp up to 28 billion. Ramp up is a great expression in politics. You know, I mean, it sounds like it's something quite big, but in fact, a ramp can be quite, actually, I was looking for a ramp down there, but can be quite shallow in gradient. And they've also, by the way, taken out of the 28 billion anything the Conservative Party might have promised in the green area in the meantime. So in other words, it probably won't be 28 billion of borrowing. So they, again, the gap between the two parties has started to narrow. The other key bit of data, as I mentioned, is this 22-point gap between the Conservatives and Labour in the opinion polls. And the other thing Jeremy Hunt plainly will try to do next week, and this will be a foretaste of the general election campaign next year, is to draw up some kind of a dividing line with Labour on tax. You'll have been hearing, I'm sure, all day today, the frankly implausible nature of some of the public spending commitments that have been penciled in beyond the next election. I think the Resolution Foundation said that unprotected departments could face cuts of 16%, and that's on the back of a pretty difficult starting point. But nevertheless, Jeremy Hunt will use whatever fiscal headroom he's given by the OBR, he will spend it. I've heard people in the Treasury talking about maxing out the headroom and not handing the headroom over to the other side at the next election. Even if that's not particularly fiscally responsible, even if the finances look shaky beyond the other side of the election and they rest on a whole load of assumptions about what the government might be able to afford in terms of public spending and future tax commitments as well. So he might do something on inheritance tax, he might do something on income tax, he might do something on stamp duty, but in any event, he'll be trying to set up a political divide with the Labour Party on taxation. My hunch is that whatever he does, the Labour Party will probably go along with it. To use Napoleon's famous dictum, don't interrupt your enemy when they're making mistakes. And I think the Labour Party's general view is you basically don't let a gap opening up. The Conservative Party keep creating things which they think are traps, and they put a big sign up saying this is a trap, and somehow the Labour Party finds a way of walking around it. I mean, for example, scrapping HS2 or some of the policies and retreats on the environmental commitments, the two-child benefit cap which Labour have accepted. Virtually everything the Conservative Party does which they think is going to pose a problem for the Labour Party generally adopts, and I suspect that will apply to some of these tax cuts as well. And it will be interesting actually if they do go for inheritance tax, what the Labour Party does on that. You know, your natural instinct is to say, well, it's a tax cut for people inheriting £1 million from their parents. What about the poor? On the other hand, polling suggests it's an unpopular tax. People think that they might end up paying it, even if they probably won't. What does the Labour Party do? My guess is that they will take the baseline that they're left by the Conservatives and work from that. And again, that comes down to the point about the narrowing of political differences. And those of us, Steph, you might just remember this, but remember what happened after the 1997 election. There was again a slight convergence in the first couple of years, wasn't there? Gordon Brown famously said he was going to stick to the spending plans that Ken Clarke had penciled in beyond the 97 election, even though Ken Clarke subsequently said, of course, he was never going to, he never had any intention of meeting those. But it's not the same as 97, because in 97, as I mentioned, Tony Blair and Gordon Brown inherited an economy that was growing and had been put on pretty stable footing under Ken Clarke's chancellorship. And then, of course, 3 years later, they took the foot off the pedal and started a huge splurge on public spending, particularly on the health service. I was speaking to David Gauke, the former Treasury Minister, and he said, well, we didn't have any money in 2010 either. Now, that's true, but the difference in 2010 was that the public services has just been beefed up by almost a decade of new Labour investment. There's another big difference, which was debt to GDP in 2010, I think it was about 65, 66%, something like that, compared to almost 100% now. So we're in a different kind of situation here. Whoever's the Chancellor is going to face a much tighter set of constraints at the next election. So what's going to be? You might want to ask about what the Conservatives do if they win the next election. Although, according to the opinion polls, that is a slightly moot point at the moment. But people like me have made a career out of getting election predictions completely wrong, and I think we have to be modest enough to admit that there's a year to go and things can and do change dramatically in British politics at the moment. But if Labour wins, what's Keir Starmer's challenge going to be? Well, I mean, the first thing is addressing those very tight public spending totals that he's been bequeathed by the Tories. What's he going to do about that? Will he, as most incoming governments do, look at the books, realise things were an awful lot worse than they could possibly have ever imagined before the election, and decide they've got to put up taxes with a view to cutting them again as the next election approaches? And I think it's very important to say that when you speak to Keir Starmer and his people, he's talking about a decade in power. He's thinking long term, and he's prepared to take some quite difficult decisions in the short term in the hope that you can actually start cutting taxes towards the end of 8 or 9 years of power. And it's possible the Conservatives could oblige him, of course, by, if they lose the election, going down a very right-wing rabbit hole as they did back after the defeats in 2010. After 97. What else will he do? Well, I mean, public sector reforms. There's an old adage that the Labour Party is always more likely to do radical reforms, particularly to the health service, than the Conservatives. And I think Wes Streeting, the Shadow Health Secretary, is someone who is genuine about wanting to change the way the health service operates. And amazingly, for somebody who works for the FT, I've managed to speak for however long I've been speaking without mentioning the word Brexit. I think probably we're going to see Keir Starmer trying to negotiate a closer trading relationship with the EU in a review of the Trade and Cooperation Agreement, which comes up in 2026. I interviewed him over in Montreal about a month ago, and he was saying that he saw that as a very big moment to try and improve trading relations. I think the one thing you have to say about that is, if your starting point is no EU, no customs union, no single market, you're basically putting the same elements into the computer that Boris Johnson did and hoping that you get a better result just by being nice and more constructive. And, so it's sort of, you could argue it's nice cakeism versus not so nice cakeism. So we'll see whether the EU actually does offer a significantly better deal. It may be that is a much longer term project for the Labour Party or any future government. And it's entirely possible the EU evolves, has a different form of membership for countries that come in from the Western Balkans, even eventually Ukraine. But anyway, I think we shouldn't necessarily attach too much importance to that at the moment. And then finally, they will try to do an industrial policy without very much money, essentially. Rachel Reeves was in Washington a few months ago talking about securenomics, Bidenomics. The big difference is the American economy is growing. The Americans are throwing $370 billion odd at their green industries. That won't be an option available to any incoming government. So you have to be a bit more canny with how you do it. And I suppose finally the question is the question that will always arise for any incoming Labour government: when does the betrayal start of socialist ideals? And normally it starts the moment the Prime Minister walks over the threshold of number 10. At what point does the Labour left, which will still be a significant force in the Labour Party, start to agitate for higher taxes, more public spending? Can Keir Starmer resist? How long can he resist? If he has a majority, it's likely to be quite a small one, because getting a majority of one will require a bigger swing than Tony Blair achieved back in 1997. So, it's entirely possible he will be vulnerable to challenge from people on the left, which will make things very exciting for whoever is doing my job. Who knows, Stephanie? It might even be me after the next election. So with that, I'll stop and maybe take some questions if that works.
So, questions. I think, where's okay, yes, because you didn't get one last time, so we'll have the...
My name is Sir Dieter Helm, SPE member. Do you think Starmer will have a secret tax plan to raise taxes, much as Jeremy Hunt has done by freezing thresholds till 2028? For example, capital gains tax, equalising rates of tax on assets as opposed to income. There could be lots of stealthy ways of doing it, much as Jeremy Hunt has done.
Shall I take them one at a time?
Yeah, we'll take that one maybe.
Yes, I mean, that's a very good question. I mean, I think stealth taxes are definitely the way forward. I mean, I think what he will do is he will maintain the stealth taxes that were already in place, that courtesy of the Conservatives. The equalisation of tax rates on capital gains, it would do. I mean, I mean, as you know, they are not going to go into the election promising to do that, as far as one can tell. But it's entirely the kind of thing one might do if one was a Labour Chancellor a few months after an election, when you discover what a terrible mess the Tories have made of the public finances. So I wouldn't exclude anything. I mean, when you look at what the Labour Party's promised they're going to do on tax, you know, the tax breaks for private schools, non-DOMs, private equity and carried interest and so on, they're drops in the ocean, aren't they, in terms of revenue raises? So, you know, I think you'd have to be fairly naive not to think the Labour Party will be starting to look at those kinds of things if and when they win the election.
Yeah, next one. Yeah, at the back.
Hello, Andrew Milligan. I was just struck by your comment at the end that you thought the Labour Party majority could be very small, because obviously with 20% ahead, we've all seen forecasts suggesting that actually the Labour Party might gain quite a large majority. OK, there's always the possibility they put an awful lot of votes into seats that they've already won, etc., etc. But you're thinking a little more about why it might be a small majority, because clearly if it is, let's say, 50 to 75, yes, he could easily be in power for 10 years. If it's only 10, he might be out within 3.
Yes, well, I mean, if it was only 10, it's possible we could be back into a sort of scenario like Harold Wilson in the 60s and, you know, go back to the country for a bigger majority afterwards. I mean, I think I'm sort of probably on the excessive, when it comes to predicting a Labour victory in the next election, I'm definitely on the more cautious end of the spectrum amongst some of my political colleagues, primarily because I've been burned so frequently before. I mean, I didn't think that the Brexit referendum would go in the no direction, as indeed most of the pollsters working for David Cameron at the time. But also the one election which I think really shocked a lot of people like me was the 2017 Theresa May election, where, you know, she went to the country, she had a massive opinion poll lead. There was empirical evidence that she was popular. She just won a by-election against Labour in Cumbria in a Labour seat. She'd just done extremely well in local elections a couple of months before the election. Everything told you that the gamble was going to pay off. And in the course of that campaign, you saw the wheels fell off. And I just sort of think that the one sort of, this is not economics, but the fact that you look at the opinion polling, Keir Starmer is less popular than his party. He's seen by people not just as a bit dull in some places, but the further north of Kentish Town you go, the more you find people who say he's irritating, he's a moaner, you don't know what he stands for, sort of quite hostile towards Keir Starmer. And I just wonder, in the course of an election campaign, whether his natural caution, contrasted with Rishi Sunak, who probably has nothing to lose and is out fighting, whether the dynamic of the campaign could work in Sunak's favour. And then just finally, I mentioned to win a majority of one, they've got to gain about 120 odd seats, a bigger swing than Blair got in 97. That's a big task. If you look at where they might get those 120 seats, they could, let's say, gain 25 seats in Scotland.
Quite easy.
Possibly. They've got 1 at the moment, so, you know, getting half the seats in Scotland would be quite an achievement. 30, amazing. They could probably quite easily win back the 40 or so seats, red wall seats that the Tories won in 2019 under Boris Johnson against Jeremy Corbyn. That gets you 65. That's about half of where you need to get to. And then you've got to win another 60 odd seats in the Midlands, in the South, before you get to majority of 1. So it's a tall order, a very tall order. So that's the reason why I'm a little bit cautious about predicting sort of landslide Labour victories.
Would you, and what odds would you put on another election fairly soon? I mean, if you're right that things narrow a bit as we get closer and it's just a very high hurdle, they would still potentially form the government, but you would have another election quite soon.
I think they would form a government. I mean, the Lib Dems come into play here, so I think the Lib Dems could potentially win 30 odd seats at the next election if on a good night for them. I think they have set their sights at a reasonably realistic level, unlike at the last election where they thought they were going to win scores of seats. So those 30 seats could be important. They're not going to do a formal coalition with Labour. I think they've been burned by coalitions in the past. I don't think they're going back down that route, but they could sustain Labour in office by voting for a Labour King's speech and a budget, possibly in exchange for some electoral reform. Who knows? Classic Lib Dem demand. Then there's, of course, the SNP. Let's say the SNP has still got 20 or 25 seats in Scotland. Will they vote a Labour government out, risk putting the Tories back in? I doubt it, because that would be punished by Scottish voters at a subsequent general election. So I think Keir Starmer could govern with a small majority or even as a minority Prime Minister for a while. But at some point, he would, if the political situation looked propitious, I'm sure be prepared to go back for an early election to try to get a proper majority.
A couple more, maybe people who haven't asked questions previously. Yeah.
Hello, I'm Chris Naylor. I'm probably best described as a lapsed economist. Just briefly, I wondered if there might be any feel for politicians opening up a bit more room on borrowing going forward. You've mentioned Miliband and that money, but something which is more working on a national balance sheet basis and trying to use that to argue the case for serious investment on things where clearly the national balance sheet, national assets would be enhanced.
Would that presumably would cut across the fiscal rule on debt, right? I mean, that would be the constraint on that, unless there's a clever way around it.
Well, that would be up to politicians at that
so
point.
set the fiscal rule, yeah.
Constrained politicians to argue, and we are in a situation where politicians are arguing about changing rules on other fronts.
Well, that is true. Changing the fiscal rule is obviously something which might alarm the city, but probably wouldn't bother the voters too much. Maybe something you could do. I mean, Rachel Reeves doesn't strike me as the kind of person who's going to let borrowing rip. That would be my instinct. But, I mean, there is pressure. I mean, not just from Ed Miliband, who's behind this green prosperity plan, but others in the party too, for the Labour government to borrow more and to co-invest alongside the private sector in green energy projects and putting Britain at the forefront of all that. So, you know, the pressures will be on them, I'm sure, to raise borrowing, but my guess is she's going to want to try and stick to the fiscal rule if she can.
And was there one more? I have a question about the autumn statement. Because you meant, just to take it back to the economics, there has been some conversation, and actually even on the Ed Balls, George Osborne podcast, about whether or not Jeremy Hunt would sort of ultimately be a political chancellor next week or an economic chancellor. And obviously there are areas where he could make life difficult for his successor, without which you can't necessarily justify as being good for the economy. Where do you think what's your sense on that? He's obviously got a lot of political pressure on him. But.
Yeah, I think, well, one of the big debates in the Treasury at the moment is whether you do stuff now or you wait until the March budget. My sense is that the political stuff is going to have to come forward now because they're in such a political mess. If you think back to the summer, the sort of stuff I was writing was about, there are big set pieces through the autumn where you can set the agenda, and Rishi Sunak set the about the front foot. You had the King's speech, you had a reshuffle, you had the autumn statement. Oh, yeah, the party conference speech, which was a bit of a flop. The King's speech, which no one really noticed. The reshuffle, which was interesting, but probably hasn't moved the dial that much. And then you've got the autumn statement, and it feels to me like some of that now will come forward. So I think the pressure will be on him to cut taxes next week. It sounds like he's got some more fiscal headroom than people thought. So cutting taxes, challenging Labour to vote against them, I guess will be one thing. The other thing he could do would be to create more fiscal headroom by penciling in even more unfeasible spending totals in the next Parliament, which would cause a problem for his successor, a Labour successor. But yeah, I think when it comes down to it, there's a balance next week between doing the good long-term things for the growth prospects of the economy and doing a lot of electoral short-term fixes. And I think the needle is definitely swinging inexorably in that direction.
We're going to get, actually, that's a good last word, but we're going to give the last word actually to the question who's patient at the back.
Hi, Sabir Salad. I had a question before on what a possible minority might mean for either party, but you've answered that. So on a slightly related note, is it, in your view, a more detrimental time than ever for the economy if neither party can secure a majority?
I think that's a very good question. I think the answer to that is probably yes. I think what people, if you speak to business and people who are thinking about investing in the UK, what they really want is a period of political stability and economic stability. So, that's the thing that comes through over and over again, the fact that we've been through this political carousel, not entirely...
All with the same party in power. We've had more uncertainty than...
All with the same party in power. And actually having a government which actually doesn't actually make things worse would be would be a helpful starting point. You know, do no harm, I think, would be a good motto for any future leader of the party. So yes, look, I mean, if we go into a situation where there's more political uncertainty, a hung parliament, the prospect of another election, that's not ideal from the point of view of the economy, I would say. But really, that's a matter for the British electorate and slightly out of the hands of everyone else, really.
Thank you very much, George Parker.
Pleasure.
I should say we also often hear George on the airwaves and Radio 4 as well, Week in Westminster. His weeks are usually the ones that you don't want to miss. All right, we've made it. A little bit late, but we've made it, and you're now allowed to have your drinks. I think we had discipline and clarity on the immediate outlook from Sir Dave Ramsden. We had how that outlook should be adjusted by a really rigorous view of sustainability by Dieter Helm. We had what we don't know and what we do know about the impact of technology on productivity and growth. And I think we had from Charlie and Anna reassurance that economists would be making weather forecasters look good for some time to come. All throughout, and I guess that's always the case, imbued with a sense of uncertainty and a desire to be clear and transparent about the degree of uncertainty in economic outcomes, whether short or certainly in the longer term. In fact, the only kind of whiff of certainty that I smelled was in that final session in talking about the outcome of the next election. But maybe that will turn out to be wrong as well. Thank you very much to all the speakers, for everyone here. I know George wants to have a last word, but we do really appreciate being able to host you all, and thank you for coming.
I had a few things I wanted to say, but I'm going to say none of them because the last thing I want to do is delay us going into that room for drinks. Just a few words of thanks. Number one, to our speakers, who were all excellent. I love that last session, very interesting. Number two, to Bloomberg, who've done a great job at hosting us. Number three, to this miraculously accurate and fast transcript machine. I have a feeling there's probably somebody actually in the back room, a really fast typer, but I hope it isn't. I was really wanting to actually say a very long word, but I couldn't think of how to get something like flocky knocking the hillipilification into that. Look at that. And I think most importantly of all, number five, last not least, Stephanie, thank you for a great job of hosting this. So a wonderful event. And yes, hope to see you all in the next room for a drink. Thank you very much.